My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the roughly hour time frame is Chris Versace. Chris, it's been a while since you and I chatted, so catch me up and catch the audience up. Who are you? What's your background? How'd you get involved in markets? And how prolific are you on?
Wow. Okay. So I actually do two big buckets of things. One is I'm the chief investment officer over at Thematica Research, where we use thematics to really identify what we call targeted investment strategies. And we do that through not only content, but through indices that support several ETFs in Europe. One, the sustainable future of food, cybersecurity, data privacy, and the third being digital infrastructure. But we also have about 19 models that we have out there that tackle a variety of thematics. And, one of the reasons I like thematics, and I'll weave my backstory into this story, is I used to be on the sell side. I was at Solomon Brothers, Donaldson, Lufkin, Genred, or DLJ, and Friedman, Billings, Ramsey, or FBR. Interesting note, none of those are around anymore. They've all been acquired in one form or another. Anyway, after years of doing sell-side research, getting started in machinery capital goods with a guy who was the number one ranked analyst, moving over to home building products, and then eventually getting promoted. After doing this for a number of years, I got very frustrated with the notion that investors were looking in these, vertical silos, right? Particularly as someone whose job was to, no matter what was going on in the market, figure out which in that silo was best positioned, whether people wanted those ideas or not. And if you remember the dot-com bubble around, 99, 2000, if you were doing machinery, capital goods, industrial, cyclicals, nobody was really paying attention to you. So kind of out of that, I developed this horizontal or thematic framework. And what we look for when, in my opinion, thematics are done right, because there's a lot of versions or slices of thematics out there. Thematics look for structural change. We do that, at least at Thematica, by identifying the shifting landscapes of economics, demographics, technology, psychographics, and from time to time, regulatory mandates and stimulus spending, which is something I think we're going to touch on in a little bit. And the idea here is to identify the properly positioned companies to take advantage of those structural changes, because they will drive revenue growth, earnings growth, margin leverage, cash flow growth, all those things that tend to result in a multiple expansion. And when you have those growing with multiple expansion, what do we get? We get alpha. So that's one of the big reason why we like thematics done right. And increasingly, we've ramped out, like I said, a number of different targeted exposure models. Some of them are doing quite well. Some of them are, like the other parts of the market, kind of being left behind. But the great thing about thematics is there's no shortage of confirming data points when you look in and around the world we live in, whether it's day to day, week to week, month to month. And with that, we actually publish something through Substack called Thematic Signals. It's free to join, so I would encourage everybody to do it. We also put out some conversations that we have with companies and other thought leaders as they pertain to those investment strategies and models. So that's one thing. The other thing that I do, in around September of 2021, I was tapped to take over with another gent, the Action Alerts Plus portfolio, or the AP portfolio, as I like to call it, at thestreet.com. So we took over from a gentleman who a lot of people might know, who was on CNBC when he opted to leave the street and go to CNBC full time. So we did that. And that is a, regular full-time job. You asked how prolific I am. 4 days a week, I do a daily video, 1 to 2 days a week, do a podcast. For example, today we're going to share one with the CEO of Duckhorn, ticker symbol NAPA. And then tomorrow I'll be interviewing EP team member Carly Gardner. So that should be a great conversation. We like to share those insights with the members. But, I have comments out every morning by 8:30, and then several other alerts out to members regarding the portfolio, regarding the economy, macro data, Fed, pretty much all the things that we need to pay attention to throughout the day, throughout the week, throughout the month, throughout the quarter, as we, put capital to work in the portfolio across currently 31 names. Sometimes we're increasing positions. Other times we're smartly booking profits. And sometimes we have to lick our wounds as well. So that's a lot of what I do. People ask, Chris, how in God's name do you do all this? It's easy. I get up at 5 and I go to bed around 9:30, 10 o'clock.
Yeah, I think the trick is to die young.
Well, I'm not like some other folks that are Red Bull fanatics. What might be interesting and somewhat surprising to folks is I've actually cut back my caffeine consumption.
I am drinking caffeine as you're chatting because I need like 3 shots every day. Okay, so I've got to assume that there are some things that are categorized as themes, as thematic type of investment portfolios, and that are not, right? So let's talk through what are some of the things that you've seen that are miscategorized.
Oh boy. So let me preface this by saying that when we think about themes, we always strive for very high thematic purity. And what do I mean by that? Well, you can have, concepts, ideas, what have you, but depending on the structure, you may or may not have enough companies to really fit the strategy. So for example, we can build models that do, 6 to 8 positions, can be anywhere, any size, anything we want, as long as it fits. Others, for our ETFs, we need at least a minimum of, low 20s, but preferably something larger. So we actually do that by using what we call our thematic scorecard, where we actually rank preferably operating profit exposure, but depending on what's publicly available, revenue exposure to the particular themes. And we do it on a 1 through 5 count. 4 is 80% or greater exposure. 5 is 90% or more exposure. So to get high thematic purity, we prefer to use 4s and 5s off that scorecard when we're evaluating companies relative to a particular theme. That to us is the right way to go. You're capturing the right companies with the right strategy. And as I laid out before, those tailwinds should push on the business and help generate some alpha over the long term. I have seen other products out there, I'm not going to name specific names, but you can think about AI, you can think about a variety of others where you really have to question some of the holdings as you tick through this. And I'm not going to, trot out the name that a lot of people have over the last 2-3 years about, geez, how is Netflix in everything, or how is Tesla in everything? I think as a consumer for these strategies, whether it's mutual fund, index or index/ETF, or even, something smaller in a model, right? You really have to, and this is no surprise, know what you own. That's true if it's an individual security. It's true if it's one of these wrappers, if you will, right? You need to review the holdings and understand, how do they fit in there? Do they fit in there? And, sometimes scratch your head depending on what the position sizing is in that particular name. So that's what I'll say about that. But make no mistake, there are a lot of folks out there that, in my opinion, have sabotaged the true power of thematics by trying to have kitschy product to capture dollars.
Well, no, actually, that's one of the direction I wanted to go, right? It's sort of, it becomes a fad, not a theme, but
yes,
it's promoted like it's some longer term theme.
100%, right? So we don't aim to build Cabbage Patch dolls, fidget spinners, or something like that. And we purposely have tried to construct our themes to withstand the test of time, because we recognize that there will be things that shift over time. So for example, I apologize, this is somewhat simplistic, but, digital infrastructure. Okay. We've had evolving digital infrastructure for some time, right? Very simple in 2G, 3G, 4G. We're in the midst of 5G. Standards are being developed for 6G. The same is true with the various, sets of Wi-Fi, other connective chips. So, there is a long-term story there, an evolving story. The same thing is true with cybersecurity and data privacy. If you think of cybersecurity and how we're seeing a simple explosion in the number of points that need to be connected and protected, right? This is a long-term growth industry. On the flip side, same goes for data privacy, especially where you see a lot of regulatory mandates coming on that. And I know a lot of folks talk about what's unfolded in Europe, but you could also see a growing number of data privacy regulations here in the US as well.
Do you get a sense, since you mentioned it, that AI and the way there's now a slew of products coming out to take advantage of AI, that's one of those fads? Because the reality is AI has been around for a while. It's just now getting much more attention.
So the way I would think about that is, I'll say a couple things. First, do I think that AI has the potential to be disruptive like the internet was? Possibly. I would argue that, if you look back in 1999 when, the internet was essentially a glorified, what's the word I'm looking for here? On a calendar, but a catalog of items, right? Could you transact? No. Could you stream? No. Could you do video calling? No. All the things that we take, for granted almost today. You couldn't do any of those, but eventually they came about. So that to me was, long-term meaningful disruption that upended a number of different business models, and it continues to do so. I think AI will do some of that, but I don't think we really know today exactly what forms and shapes that's going to take. So I think it's, we will learn more as time goes on. Now, in terms of investing in AI, okay, well, just like we saw in the dot-com bubble, and I'm not the first to share this thought, we are seeing anybody and everybody trot out some way in which AI is going to help themselves and, disrupt their business, augment their business, reinvigorate their business. And I just get very nervous when I see everybody doing that. And I think the most recent one, I think there were two of them. One was today, Delta Airlines said how they're using AI to improve their flights. But the one that was far more telling and scary to me was when Dan & Yogurt said how it's going to use AI to reinvigorate its yogurt lineup. So I get very nervous at that.
Whoa, what? Right, all right, hold on. What the fuck does that?
Yeah, no, I know exactly right. It's something about matching taste profiles and ingredients and stuff like that. And I was just like, wow, talk about trying to grab onto the AI life preserver with both hands. So I was blown back by that. Right. And you've been around long enough to know that, when everybody starts leaning into something as strongly as this, just like, blah, blah, blah.com happened in 99, 2000, you tend to feel those little hairs stand up on the back of your neck.
But it's honest, it's no different than these companies that would just put .com after.
Yeah, 100%.
Right? And then they see a pop in the price.
Yeah, pets.com. Boom, there you go. So I do think we are seeing some of that. But again, your question is more about investing on it. So, if you were to craft a model of how many companies are really doing something disruptive as it relates to AI, whether it's software or chips, you have to ask yourself, are there really enough out there to hit, low 20s and really develop a nice ETF product? I'm not really sure that there are. I say this because we have an AI model that, of course, has done extremely well, but it's only got 6 or 7 names in it. And they are, to be candid, the usual suspects. So hardly revolutionary. Okay. So I do get a little, perplexed at that. But you know what? On the one hand, I have to step back and say, wow, people are willing to buy this. Hats off to the folks that are doing this. They're far smarter than I am, apparently, or at least better marketers.
That point, by the way, about 7 names is interesting because oftentimes the hot dot of the moment tends to be just a select number of stocks that are moving off of that. And then if you're trying to create products, now you've got issues in terms of how do you have a diversified basket to represent some theme, right? When in reality, there aren't that many names to play. So I get your point about purity, but I get the point also that most people don't think that deeply, right? They see the name of a fund and they assume it's the exposure of the fund.
Well, yeah. I mean, and again, hats off to the folks able to do that. I like I said, they're smarter than I am or better marketers. But, I think that just in the environment that we're in, you have to be especially knowledgeable about what it is you're buying so you understand what it is you're actually getting when you buy it. That's all.
Fortunately, most people just think they're buying a chart, right? And that's just the nature of the business.
I mean, look, you're talking to a guy. I mean, think about how I got started, right? Industrials and cyclicals, right? Total fundamental analysis, roll up the sleeves, read the 10Ks, read the Qs, all that good stuff. Luckily on the AAP team, I've got Helene Meisler and Bob Lang who tend to look at the charts. But that's a nice added layer, but that's separate from the conversation we've had thus far.
What about some of the themes that you've seen more recently that make you scratch your head as saying, like, is this really a thing? Gotta be some.
There are, although I have to be honest with you, I've been more focused in getting our models up and running. So I haven't paid as much attention to some of the other strategies that are out there, but there are always a couple, there's one that I saw recently. It's not new, but I just happened to run across it where we're talking about the pet economy, which I think is, kind of silly, to be honest with you. There's some others that are interesting out there. Circular economy, for example, and I do appreciate folks trying to weave together, a new theme. It's not, I'll be honest with you, it's not easy, right? It's almost a lot like if you're a parent getting ready to name, an expected child, you start running through the list of names and everything's like, no, I don't like that. I'm I'm mixing and matching all these different nicknames that I can't stand, so we can toss that name out. So it's very hard to come up with a theme that captures the structural change that hasn't been done before and that can stand the test of time. I mean, those are three very tough things to ask for.
All right. So I want to go to the name of the space because we're going to be talking about infrastructure and stimulus. I think it's funny that we're talking about stimulus when you have high inflation, right? But that's the nature of Washington because, the reality is people vote based on nominal, not based on real. What's gone on? Just lay out the framework for everybody as far as what's gone on with Washington in terms of stimulus and then, the bigger top around infrastructure spend.
So there's actually a couple different areas of stimulus, right? So the infrastructure bill has gotten a lot of talk. Of course, that was signed back in 2021, sorry. But, and there are various components to that, helping rebuild airports, bridges, tunnels, roads, also money for the EV charging network build out, which to me is a great opportunity as an investor, even though the stocks haven't worked out. But there's other infrastructure spending out there as well, or tying it with reshoring and other stimulus spending. Of course, the CHIPS Act, which is no longer just the CHIPS Act here in the US. There's a CHIPS Act in the Eurozone. Japan is spending, and it appears that, based on the meeting last week, India via Modi is looking to do something as well. So there's that. And then there's also another one that I have to be honest with you that there's the Inflation Reduction Act. I almost forgot that. And then there's the one that I always forget the naming on, but it has to do with public safety. And it's the one that I like, just given a position that we have in the AAP portfolio with Axon. And if you'd bear with me a second, I'll be able to give you and the listeners the name, which is the American Rescue Plan Act. So that's a lot of dollars coming out of Washington for various initiatives. And, I took the AAP portfolio kind of in that direction during last year, increasingly towards the back half of the year when we were concerned, just like everybody else was, about the much discussed, highly anticipated, yet to be seen economic recession here in the US, and as well as most likely in other parts of the world. So we were trying to figure out where would we see pronounced, dollars flowing, spending happening that would push on businesses. And, those three or four that I rattled off are rather, positive, especially if we do see a slowdown, that spending will continue. And I will concede that given the inflation that we have seen, the expected impact is likely to be slightly yes, but directionally the spending is still going in the right direction. So on that, you take a look at the heavy equipment companies or the aggregate companies or the rental companies that have to build pretty much all of this stuff, whether it's, Caterpillar, a certain segment of, John Deere, Vulcan Materials, United Rentals, and a variety of other companies that are out there, the nice push-pull on their business. And what I like about that aspect of the physical non-residential construction is there's great data out there. One in particular, you could take a look at the Architectural Billing Index. You could take a look at the monthly construction spending numbers that are out there, particularly those numbers on the non-residential side. When you strike out housing, you've started to see some really nice year-over-year growth as the spending really starts to ramp. And I think that was one of the more frustrating parts for people was the lag time between the Biden infrastructure law being passed and the uptick in spending, because plans need to be submitted, they need to be approved, funds need to be dispersed. And we're seeing that happen right now as well with the EV charging build out. We did a podcast with the company Orion Energy, and they were very big with their core business, retrofitting big box retailers with LEDs, but they made an acquisition in the EV charging space. And, they were very upfront in saying that, look, private dollars are flowing for EV charging right now. Public, dollars are starting to flow, but the real impact is in the back half of the year. So when I see rising, sales of EVs and get excited about EV price points coming down. I don't know if you saw, Michael, Volkswagen said they're working on something that would put a entry-level EV sub $22,000, which is kind of mind-blowing when you think about it. And I see that and see the evolving pain point there for EV charging, more people on the roads needing more charging stations. And just for factoid for those folks, I think at the end of 2022, there was something like 50 EVs on the road for every charger. And so you just think about that and the stimulus spending and the Biden infrastructure law for EVs, that tax credit, the outlook, in my opinion, is favorable for that over the longer term, creating the long-term pain point for EV charging stations. But again, the message there is that the spending from the infrastructure dollars will accelerate in the second half of the year and get even bigger in 2024. So when you look at companies like Blink Charging, EVgo, ChargePoint, even Tesla, right? There is a nice tailwind emerging for those businesses.
Shouldn't we be seeing some of the commodity side respond, at least at the margins? I mean, if all this is still coming, you'd think that the commodity futures would respond more. And I'm just looking at various charts, doesn't seem like there's really much anticipation of increased demand.
For which particular commodities?
Well, just commodities. I look at copper. I look at...
Yeah. Well, come on. Everybody looks at Dr. Copper, right? So I agree with you, right? I think that there's this, overhang, as I mentioned earlier, about this recessionary concern about the coming downturn. And look, I look at the various PMI data as well, both manufacturing and services that I'm sure you do, and we know that the service economy continues to carry us. I'm not, going to be as bold as Raoul Pal and say that I think that there's a turn coming in the manufacturing in the next couple of months. Manufacturing PMI, I kind of go data point to data point, look at the new orders, and I don't see a big improvement in manufacturing. I see the net export, data continuing to soften as well, which is why, just for what it's worth, it's a little interesting, the comments out of China today. I think one of the premiers was saying that the second quarter is going to be even stronger than the first quarter. Not really seeing it in the data. So I do watch a lot of that data as well. So I'm not really sure why all the commodities haven't picked up. I think as we see the ramp happen, it'll continue. But remember too that, housing has been up until the May data, weaker than expected. So that May housing starts data was a bit of a surprise to me, especially given where mortgage rates are likely to go in the second half of the year. So I'm watching that to see if that's a blip, to be candid.
Yeah, and I'm going to make this assumption so that a big part of the infrastructure equation is more than just what's going on in the U.S., but just globally. If China were to stimulate, given that their inflation has gone the exact opposite direction post reopening than people thought, right? That they're probably going to have to do some measures, which might be why that statement was out there. Second half will be more powerful. They're expecting some movement there.
Yeah, there was some chatter. I saw it. I forget where I saw it this morning, that the Chinese banks are being encouraged to loan more to manufacturing companies. I'm not really sure how that's going to play out, but just more signs that they're trying to open the spigot.
Speaking of that, are there interesting international thematic plays that haven't really come to the U.S.?
You're kind of setting me up to pat myself indirectly on the back. I would say probably one of the more interesting ones, although I think Van Eck probably has a product now on it. It's the sustainable future of food that really looks at how do we squeeze more out of the land than we have today as the population continues to grow. What's happening in agri-science, precision ag, but there's also elements of other sustainability, everything from packaging to looking at non-meat proteins. So that's kind of an interesting product. And we worked with the guys at Rise ETF to build that product with them. That's probably one of the more interesting ones.
So everybody, please make sure you follow Chris Versace here on Twitter. But if you want to come up and ask questions, click that bottom left mic request button. And again, this will be in podcast under Lead Lag Live. So it doesn't sound to me like you think that thematic investing is challenged by a recession that is still yet to come, right? The fabled recession.
Well, I mean, that's a very sweeping statement, right? I think there'll be some strategies that continue to work, right? So for example, we were talking AI earlier, right? So, the way we think about our digital infrastructure and connectivity is that there's this ongoing virtuous circle where, the more data we create, the more data we consume. So, we look at, rising internet levels across the globe, the continued, I think, Nielsen had some very good data out yesterday about the continued growth in streaming at broadcast TV. I know who watches broadcast TV. It's a little surprising, but it continues to grow. We look at other aspects of streaming and just overall digital content, and then we layer in the potential for AI and what that means. You look at Apple's mixed reality headset. You look at, Meta is now offering a $7.99 a month VR subscription. I mean, it's, all these things plus IoT tell us that there's going to be a lot more data crossing the digital networks, driving densification, driving continued data center build out and the like. So, some of these will continue to happen and the market will have to catch up to that. But there's other issues out there like, consumer inflation fighters that I think plays very well during the recession, especially given the fact that inflation has been, hitting consumers longer than expected. So it really depends on the theme.
Yeah, no, you're correct. It's sweeping, but there will be things that thrive and things that obviously don't.
Well, I think what will happen is there will be, show me stories, right? I want to believe, but I need to see it in the data. I need to see it proved out. And I think as we see signs of that's where you'll see people, flock to first.
Outside of thematic investing and everything that you're working on, Chris, what other things get you excited when you look at opportunities in the industry? Let's take the investing side of it, just in terms of looking at our industry. I'll tell you, I'm very cynical. I think the whole industry is longer term in a lot of trouble unless you can find a really powerful niche the way that you focus your firm on. But where do you find some disruption in the finance?
So this may not be what you were expecting, but the notion that new investors can work with, Cash App, Tornado, and a variety of others and start investing, leveraging fractional sharing so they can take advantage of some of these, strategies, very easily with, $200, $500, $1,000, a month, a week, whatever it is to get started and build their portfolios, right? In that manner. To me, that's very exciting because it opens up a whole new opportunity for people to get starting to invest, right? And as they do that, they'll start looking out for other strategies or strategies that fit with where they want to invest and other resources. So, selfishly speaking, that is kind of good for me long term. But I just get excited by that, breaking down the barrier. It's almost like the next step where, I'll be 55 in September. So when I was in my teens and early 20s, for the most part, you needed a broker, right, to get quotes or to do something. There was no internet. And, through a combination of technology, though the availability of information has come down, the ability to trade has come down, now skipping past, you had Ameritrade, E-Trade, Schwab, where you could do, very much for the DIY investor. But now it's increasingly in the palm of your hand and you can do far more creative things than simply buying, XYZ mutual fund. So that gets me excited.
Yeah, I'll share on that only from the standpoint that I think it creates interesting other opportunities. To the extent that, yes, it's good to lower barriers, but lowering barriers also results in, a lot of newbies and kind of more emotional types of traders, I'd argue, at the margin. Right? That makes for...
Yeah. That makes sense.
Yeah. It makes for opportunities for those that are more longer term, but also makes it frustrating from a noise standpoint, I'd argue.
Well, I would like to think that as people gravitate in, kind of like being a wine drinker, right? As you slowly step in, you become more curious. You start reading a little more, right? You start investigating, and building your knowledge base. So I may not be as cynical as you, but you may be right.
Yeah, no, I'm with you on that. And if anybody wants to come up and ask questions, click that bottom left mic button. Okay, so we hit on thematics, we hit on infrastructure, broader stimulus. Is there anything in your work that would suggest that where we are in this 4-year cycle has any impact on the likelihood of adoption of themes, right? So I always go back to third year of the presidential cycle tends to be the strongest historically. That's what we're in now. As investors get more bulled up, they probably want to take more speculative bets. And, there are going to be a lot of thematic speculative bets that are out there. So anything that would suggest that sort of the time with which one considers themes in general makes it more likely for bigger gains versus not?
Oh, that's a good question. So if we think back, right, the vast majority of the market gains, despite some recent on again, off again broadening out, has been driven, as you know, by, 6 or 7 stocks, which also have to be, the same 6 or 7 stocks that are in the S&P 500 as well as the NASDAQ composite. Right? So we haven't really seen that real broadening out in the market. We have seen some of these themes already start to perform, like our Rebuilding America theme, or in the AEP portfolio, United Rentals or Vulcan Materials have been very strong performers for us. So there are some areas that are starting to happen, but I think that until we get past a couple things, knowing for sure that the Fed has, kind of stopped tightening, when we start to have some confidence in those 2024 earnings expectations. I mean, as we sit here, the second half of the year for S&P 500 earnings are supposed to grow 7.5%, second half versus first half, even though they declined the last 2 quarters, right? And then you have, again, consensus expectations for 11.5% growth in 2024 over 2023. And I think there's a lot of questions as to, are we going to get that? My sense is probably not. But then again, what might we get? And I think that's the question a lot of people are kind of wrestling with. And hand in hand with that, when, if you believe the Fed's, latest dot plot, when will they start cutting? Will it be first half, second half? So, my thinking is that the next potential bull market, could it be the second half of next year? It's possible. Depends on what we see in terms of any recession. Is it short-lived or not? But when does the Fed start cutting rates? To me, those are the big questions, along with earnings expectations and the current market multiple, that kind of, have me wondering about where we go next.
Yeah, although it's interesting, I'm sure you've seen those studies too that show that, usually at the pivot is when things actually kind of go haywire. I'd argue this whole environment's been very non-synchronized, right? I mean, it's not just the fact that large caps are so dramatically outperforming small caps, but sector dispersions are so incredibly high. It makes it hard to sort of see how a rising tide lifts all boats, which makes it sound like you still think we're actually in a bear market if you're saying new bull market next year.
Yeah. I mean, as Bob Lang, who's one of the AAP team members, likes to say, you can see tremendous rallies still inside a bear market, and I think maybe what we've seen is that 38 to 42, 4,300 level on the S&P has probably moved higher, but that doesn't mean that we're really started a new bull market yet. I do think that the next couple of weeks, when we start to get guidance for the second half of the year, that's when we're really going to start to see what's next for the market, like I was saying. And believe me, I'm anxious to hear what Taiwan Semiconductor has to say in the next couple of weeks. Are we seeing all the excess Chinese smartphones? Are we seeing that inventory move down? Is it seeing the flow through from AI, the pickup of its high performance computing business? And what could that possibly tell us about what NVIDIA, AMD, Marvell, Qualcomm, and the others are going to say in the ensuing weeks, right? So it's going to be an interesting time. Make no mistake.
I'm curious with the work that you do at the street. I'm assuming you see analytics. Are there certain stories that are getting more attention or traction from readers?
So I would like to say that I see that. I don't, largely because most of what I do is behind the paywall. Even when I have the opportunity to sit in for Doug Cass at the Daily Diary, which I love doing, I'm still behind the paywall. So I wish I had more comments for you on that. And, it would be insightful because I don't know if you know this. The Street is now, has been explained to me, the top 9 site for financial and stock market news. So they clearly have some reach. I know that generally speaking, fast food and some other categories do well, but in terms of how some of the more topical things shake out, I have no insight on.
Yeah, it's really just fascinating me to see what people tend to gravitate to, obviously, if you have access to that. What do you think is not being covered in the media currently that is getting your attention?
Oh boy. I would say
emerging themes, let's call it, or something that,
Well, I wasn't really thinking about that per se. I mean, there are some things out there, like, I was just reading yesterday, this morning, Mark Absey, who's part of Tematica, sent me this story about how Sweden is pushing back on renewables, opting instead to build out nuclear. Pretty interesting, right? Not exactly what a lot of people are thinking about, but very telling. So it's things like that kind of on the fringe. I don't think we're hearing enough about, be very honest with you, data privacy, digital identity. I think those are very sleeper themes going forward. I'm just trying to think of what else is out there. And the other big topic for me, which I think we've heard a lot about, is that what this current earnings season is likely to be. Because to me, that's going to be very important.
Yeah, I don't know, man. I often wonder if any of that ultimately matters for stock price, because FOMO is more important than fundamentals with the Fed.
Yeah, well, what?
To an extent.
FOMO is important in the very short term, I think, right? And, you take a look at what's happened. I mean, great proof point is you see what's happened in the market, the first, 6 months of the year. And, a couple of weeks ago, we had the largest inflow in 18, 19 months, all into US equities with a bent toward technology. So you are right. But I think given what we do, and I'm sure you do this, but we need to understand that and account for that in our thinking when things might be getting a little, what's that word? Oh, yes, frothy.
I would use more colorful language.
Well, I'll just say this. It's your podcast, so you can say whatever the fuck you want to say.
That's a fair point. Well, I want to bring in
Sure. That's actually a great question. So, for the listeners, as I mentioned kind of at the very beginning, we do try to identify structural change across a variety of shifting landscapes, including demographics. And, demographics are kind of fascinating. There are certain ones, aging of the population. We just published yesterday on Thematic Signals 4 or 5 links, including, is the US ready to, properly deal with its aging population? And I think I saw kind of as part of that, the average age in the US is now 39 or 40. And if you start to think about that and what it means, I mean, it's really starting to be scary. And, the key for that is the acceleration of the boomers and the ripple effect that they will have in terms of whether it's housing, healthcare, financial services, and the like. But the ones that you're talking on, if you think about the middle class squeeze, or as we now kind of refer to it on the flip side from a positive sense, consumer inflation fighters, you take a look at the percentage of folks that are undersaved for retirement. You take a look at what the retirement savings are, and you think about that slug, and then, we were working on this even before, the last, 12, 18 months of inflation pressure. There's a number of people that live paycheck to paycheck as well. And, these numbers are kind of, well discussed in the mainstream media, but you need to think about the impact of that. So what we tried to do is really kind of pull all this together into that middle class squeeze, because, you have, the luxury goods people, and you have products kind of at the very lower end, but you're seeing, certain companies in the middle, Target and the like, kind of, really come under pressure. And I'm not really sure what their long-term future is. So that's what that tries to capture. And the solution, if you will, which is the investment theme, is what companies stand to benefit. And it's those that really help companies stretch their individuals stretch the spending dollars that they do have. You can talk Walmart, BJ's, Costco, Dollar Tree, and the like. In terms of your question about the rising new middle class, again, this is something that we developed, a few years ago, but I still think it's, relatively prevalent, just slightly different now. I would almost say that parts of it have morphed into what we call, affordable luxury, or the model we have, the luxury buying boom. There, you look outside the US, particularly Asia, particularly China, and you look at the rising disposable income. Several years ago, almost a decade ago, I think people were talking about that impact as it was relating to the protein complex when they were trading up from, rice-based diets to protein-based diets. Or at the time when I was, visiting with Colgate, they were talking about how people were going from tooth powder to toothpaste and trading up in their lifestyle. So as their disposable income rises and they adopt, a more, for lack of a better term, Western consumer profile, what does that mean? You see that today with companies from, LVMH to Coty targeting, certain products in their premium line, in China in particular, looking to grow that. Estee Lauder's another. But even if you look into some of the big luxury houses, they too are targeting that there. So I hope does that answer your question? I hope. Sorry, I kind of, babbled on a little bit.
No, but I think that was good. Okay. So Chris, just final thoughts for the audience here before we wrap up, since I'm doing another Twitter space right after this. For those that want to think about thematic investing, biggest piece of advice to make sure they're not doing the wrong thing, which is getting into a theme because it's a fad. And then how do people find more of your work?
Sure. So think about 2 things, right? I would say, make sure you understand the strategy and how does it, when you conceptualize it, how does it stand the test of time, right? That's really what you need to understand on that. And when you look through the constituents, make sure you do your homework and understand how they really fit into it. Again, the best example that I can give is how Netflix ever got into a space ETF. I have no idea. And in terms of following me, at Chris J. Versace on Twitter, although candidly, I'm not the best Twitter person, I would say you really want to take a look at aap.thestreet.com. That's Action Alerts Plus. And then you could just go simply to Tematica, TEMATICA.substack.com, and you can subscribe to Thematic Signals. Those are probably the easiest things.
Yeah, a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Chris Versace. Thank you, Chris. Appreciate it.
Thank you. Happy to do it anytime you want.